Good afternoon. It's Jeffrey Christian of CPM Group. It's about 1 o'clock the afternoon of Friday, the 29th of September here in New York. I want to talk a little bit about what's going on with gold prices and also with precious metals prices. They've all shown some volatility and some weakness. There was a sell-off across asset markets on Wednesday. Wasn't quite clear what was going on. There's been a lot of concern about developments in the bond market and in interest rate markets, and that has been affecting assets across the board. Gold prices did come down. They're about $1,870 as we speak. That's out of the range that we've been in over the last period of time. This is a chart that we publish in our monthly precious metals advisory. This is from the report that came out in early September, on the 8th of September. And in the Precious Metals Advisory, we show our expectations for prices, a range of prices over the next 1 to 3 months. And then we have projections for average prices for 8 quarters going forward on a rolling basis. And we do that for gold, silver, platinum, palladium, and rhodium. I just really want to talk about gold today because as we look at the different markets, silver, platinum, and palladium have held up relatively well. They're still in recent ranges. Silver has moved down. It's below $23. It's around $22.60, I believe, as I'm speaking. And we actually have been saying that we thought that the price of silver would probably trade down to around $22.50 in September, and maybe as low as 22 in October or November. That's our 3-month range, the bottom of our 3-month range that we're looking at, and we seem to be headed that way. Our expectation is that the price of silver probably will hold above $22 over the course of the next 2 or 3 months before starting to rise toward the end of the year and into the 2024. Platinum has come down. We had a bottom objective in our platinum trading recommendation of 905. It got as low as 904 this morning for the October contract. The October contract's now deliverable, so the open interest and trading activity has all shifted into the January contract, which is around 920 the last time I looked. And palladium has been holding up relatively well, stronger than we had expected. But a lot of the activity, as I said, has been focusing on gold. And that's to be expected because as you start saying, well, given what's going on, what do we think about where the price is going? And to answer that question, you have to understand why it is that prices fell on Wednesday. What is it that's causing that? And what we can seem to see is that it's been primarily investor and financial market concerns over interest rates and interest rate activity. And interest rates are rising. That's true. They are still very low by historical pre-2008 levels. We're into a new interest rate regime. Gold promoters have been talking about 9% interest rates on the immediate horizon. That's highly unlikely to see. If you look at the Fed dot plots for the Federal Reserve, you see that they expect interest rates really to be peaking now or in early 2024. So they have interest rates pretty much at their peak now in the end of this year, and then coming down in 2024, 2025, and beyond. So they're looking at nominal rates peaking around 5.5–5.75%. And then you have to really consider real rates when you think about what investors' attitudes are going to be. We're hearing a lot of weird things, like there were people talking about the basis trade and how it could be disruptive. Probably not going to be disruptive, the basis trade. What's going to be disruptive is that people are making repurchase agreements and swap arrangements with $900 billion of treasuries as opposed to $100 billion or $300 billion in the past. So you're at a bigger level, and there is a fear of large numbers that many people have, and they kind of panic about that. But Our view is interest rates have risen. They haven't risen as much as a lot of people had feared. They probably haven't risen enough to really be too detrimental to overall economic activity. We do see a recession next year. I think the Fed is looking at it too. They have much stronger GDP that they're estimating for the full year now, and they have much lower GDP for next fiscal year, which starts on Sunday, of about 1.8% for the full year. And if you look at it on a quarterly basis, a 1.8% full year GDP figure could easily include 2 quarters of contracting economic activity. I've said it before, I'll say it again. If you look at the real economy, supply and demand for goods and services, what you've seen is a lot more strength than a lot of people imagined and expected. And where you've seen interest rates have an effect, it's in housing and auto. And those are 2 very important sectors of the economy, but they're also very interest rate sensitive. But if you delve into the housing and auto markets and industries, what you find is that perhaps more of the weakness that you're seeing is not related to higher interest rates. It's more related to dislocations and imbalances between supply and demand. In housing, the housing industry still wants to make McMansions because they have a higher margin. But the demand for housing is for smaller units, starter homes, reasonably priced homes, and empty nesters looking to downsize their housing. So there's a mismatch between supply and demand, and a consequently very high price on average and in terms of median housing prices, and a reduction of stock of the kind of housing that people want to buy and can afford to buy. So interest rates probably have had some negative effect on the housing market, but the primary weaknesses are probably coming from supply and demand factors within the housing market and housing industry. Similarly, in the auto industry, yes, higher interest rates and higher loan rates, and the fact that you have this massive amount of private debt in auto loans and in other loans have all had an effect. But the real issues are probably demographic. And again, you have automakers who like to make big vehicles because they have a higher margin, and they like to charge more. And then you have more and more people, the demographics are shifting in terms of auto demand. So you have more and more people say, I don't even want to own a car, I'll rent a car, I can do ride sharing and other things. And if I do want a car, I want a smaller car. I don't want to pay $40,000, $50,000, $60,000 for a car. I'd like to pay $25,000 or $30,000 or $35,000 for a car. But the automakers don't want to supply that. They want to sell pickup trucks and large SUVs where they have a higher margin. So you have supply and demand factors in those 2 markets probably weighing more on demand and sales and production than you do interest rates. So our expectation is that interest rates are rising. They're probably close to their peak. We may see an increase in November, or maybe at some point between November and, say, March of next year. But we seem to be at the peak. Interest and inflation is slow in coming down. So even with 5.5%, 5.25% Fed funds rate and short-term rates, and 4.5 on the long rates, the 10-year bonds, what you're seeing is that real inflation-adjusted returns are not so high as to turn off demand for precious metals. If you look at the relationship between real interest rates, and real gold price changes, what you see is that it takes real interest rates of 3% or higher to generally turn off investors. If you can get a 3% or higher real return on Treasury bills, then you start saying, maybe I don't need to have so much money into gold. May not get rid of all my gold, but I might lighten up on my gold and focus on interest-bearing assets. But to get to 3% real rates, you probably, if you have inflation, say, running at 4.5% to 5.5% now, you're talking about 7.5% to 8.5% nominal rates. And while there are gold promoters talking about that, No one in the mainstream financial markets are talking about it. Certainly not the Fed. And most other interest rate economists are not contemplating 8% nominal rates for short-term Treasury bills. There are changes, and as I talked about before, we are using the term that we are entering a third era for post-war interest rate policies and levels. It's going to be radically different from what it was in the past. This is the yield curve, and I'm just looking at the most recent time. As recently as July, the spread between 10-year treasuries were a full percentage point cheaper, lower interest rate than 2 years. It's now around 50 basis points. So half of that negative yield curve has disappeared. And as I've talked about in past videos, we don't see inverted yield curve as necessarily being indicative of an imminent recession. There may be a recession, but not necessarily for this. That's the way interest rates interacted with the real economy prior to 2008. From 2008 until 2021, you had a zero interest rate policy and you had extremely low interest rates, and the yield curve simply wasn't applying. Going forward, since 2021, we've seen a yield curve invert, but that's not necessarily indicative of an imminent recession. It really wasn't all that indicative of an imminent recession prior to 2008 either, but that's beside the point. So we see the interest rates changing. Interest rates are kind of topping out. They're probably not all as problematic as some gold promoters would like people to believe. But there's a great deal of uncertainty as to where we go. And then on top of that, you add things like the probability that over the weekend the government will shut down, the U.S. government. And what's that going to do? Well, it probably means maybe a slightly lower dollar, not a sharply lower dollar, because the U.S. economy is still much more interesting to investors and financial assets than other investments in other denominated in other currencies. So you might see a slightly weaker dollar for the duration of a government lockdown, and you'll see a further reduction in the esteem with which people around the world hold the U.S. government. That could be positive for gold and silver. But if we see a slight weakening of the dollar, we see a slight positive strengthening influence for gold and silver. PGMs are still exposed to the UAW strike against the three traditional large automakers in the United States. We have about 11 auto companies that manufacture cars in the United States now. So the idea of the big three that used to be the sole manufacturers of automobiles back in the 70s, it's a little bit of a passé concept. The world's radically different. But PGMs are clearly somewhat being restrained by the auto strike, which is going to be reducing production if it goes on much longer. That's about where we see things going. It's about all I have for this week. Have a good weekend. Take care of yourself and those around you. Try to do something good for the world. And you can go to our website. You can get some free reads. You can order our yearbooks. You can order other research. You can send us a note at info@CPM Group if you want to talk about consulting services that we might provide you. In the meantime, take care, and we'll talk to you next week.